And we're back. It's Wednesday, July 16th. Paul Capetta's here, wearing a very nice collared shirt, making me look bad. How you doing, Paul?
I'm doing great, Frank. How are you?
Oh, it's just a fantastic Wednesday morning. It's pretty hot outside. I have a good amount of sweat on me still from walking in.
The humidity was no joke this morning.
It hasn't cooled off, really.
No.
I'm going fly fishing in Michigan this weekend. But it looks, knock on wood, like it's going to be like 70 to 75 degrees.
That's beautiful.
Which maybe I'm getting ahead of myself because maybe the humidity for some reason is going to be like unbelievable.
Yeah.
But I think it'll be nice.
I mean, it was 94% humidity this morning. You felt it immediately as soon as you walked outside.
I went and picked us up some hot coffees.
Yeah.
Because coffee's just got to be hot. I know you guys can do the cold coffee, but
anything with caffeine, no cream or sugar. Just
Celsius? Are people still drinking those?
I'm pretty sure those are bad for you. No. I don't know.
Well, it can't be as bad as it was for the euro yesterday. Let's get into the platform because I want to talk about the price action we saw yesterday and then also go over what I thought was a great study from our main research man, Glenn, on essentially big moves, but more closely tied probably to binary events, economic data events, and whether or not markets reverse in the hours after those events. We saw a hell of a reversal yesterday in this Eurodollar market. Looking at the hourly chart, the study that we're going to look at is hourly data, so we'll make it a little bit of an hourly show here. Paul, yesterday, inflation is reported in the U.S. It comes in higher than it was last time, lower than expected. Classic mixed number. You have immediately dollar selling. This is, I believe, the move off of the number. It's right. Yeah, it's right in here. This would have been the hour. This is 8 o'clock Eastern. The number comes out at 8:30. You have a rally in Eurodollar all the way up to was trading around 116.50, 116.60, going close to 117. And then, Paul, the rest of the day, it was a bloodbath for the euro. It was one of the strongest rallies we've seen in the dollar the last several weeks. What happened in your mind?
There was some good digestion of that number right off the bat. It was a good 15 to 30 minutes where you didn't know where euro was going to go for the day, and then they started hitting it aggressively, and they didn't really give it back at all. We were kind of sitting at the desk waiting for the give back to come, and it just didn't come. I think we finished pretty much at the lows yesterday. We've seen a little give back this morning. It did bounce off the 116 level, which gives you some hope, but we're trending that way back, and we've got PPI this morning, so it's going to be another kind of interesting morning ahead of us here.
It's just always funny to me that the economic data, it matters in a way. The news items, they matter in a way. But there's some kind of this might sound crazy, there's some kind of higher market power at work. And I don't know if it's, some people might be like, well, it's the commitment of traders. It's how many people are short versus long. And then if it's at this certain price point, then all of these shorts, they have to liquidate these positions at some point, or if they're all these longs in the Eurodollar market, they have to liquidate these positions. Whatever it is, there is something at work at a time like this where it just seems like the vibe has changed on dollar in the last couple of weeks. The sell-offs in dollar are bought back relatively quickly, and here we're looking at Eurodollar the last couple of weeks. And you can see ever since they got up to 118, Paul, every time they've tried to rally this Eurodollar market or sell off rally the euro, sell off the US dollar, it hasn't been able to get any legs beyond any of these prices and has started to work its way lower, actually. And yesterday was a classic day where it's like, okay, the expectation is higher inflation in the U.S. The inflation number that comes out is less than what was expected. And so right off the number, you get the classic what would have been the theoretical reaction? Well, if inflation's not higher, then treasury prices should move higher because interest rates are going to come down here in the U.S. And you had that for all of 10 to 20 minutes. And then just overwhelming, complete reversal of that entire idea. And it just like seems to me going into the number, it was like, okay, this number, it rarely is a huge surprise. Rarely is it like, oh, we're expecting 2.7% and we got 7%. And it's like, it doesn't really happen. And so the number at the end of the day probably didn't matter. It just feels like there's been, like I say, like a vibe shift. And now people are either liquidating their dollar shorts or people are jumping on the dollar long train because interest rates don't appear to be coming down as fast as previously thought in the U.S. And it seems like the kind of X factor in the room is the Trump tariffs, Trump Iran-Israel war kind of like fear factor seems to diminish as well.
Yeah, there's a lot to unpack in the CPI data yesterday. Obviously, CPI takes into account energy prices, so that's a piece of it that you have to take with a grain of salt because energy prices were higher in June. But it comes back to this idea that inflation's still pretty sticky. We thought we have had inflation coming down, as our little chart there will show you, but it hasn't got back to that Fed target of 2%, which is where they look to start cutting rates. Now, many will argue that maybe they're going to be behind because this is lagging data, but the job market has held up, so they don't really have a reason to get kind of into an easing mode at the moment. So that brings back your dollar strength. It's an interesting one. I mean, I think you called out the Treasury move yesterday. I mean, that
Crazy
was crazy.
Move. Crazy move. Yeah.
But yesterday was a very interesting day in that you saw price action that we maybe haven't seen in a few months, probably 5 months, I'd say.
Yeah. If this was April, May, June, that number would have come out. They would have rallied Eurodollar 20, 30 points, and then it would have just drifted higher for the rest of the day. But like I say, it seems like, and yeah, maybe it is just simply the fact that like we had a strong non-farm a couple weeks ago. This is now inflation data that didn't surprise to the downside, and it is higher than it was previously. And so now it's like, okay, we're just going to take all of the interest rate cuts out of this market, and the U.S. dollar is at lows in a ton of these Forex pairs. And so now it's like, all right, it's a little bit of a dollar bull period, given all of the context of the dollar lows plus taking these cuts out of the market. Because, yeah, now you're looking at this July Fed meeting. And it's funny, this is almost always the case, and so I'll reiterate it again, that these odds go to close to 100% in one place or the other, no action or some action. Almost every time by the time the meeting actually comes up. And that's why these seemingly small data points like inflation or non-farm, or you got PPI again here today, GDP, whatever, you might think like, oh, well, I'm just going to wait for the big Fed meeting because that's when the actual decision is going to be made. The decision is made, these small data points on the path to that Fed meeting, because, yeah, this chance of a cut, Paul, a couple of days ago was at least more than 5%. A couple of weeks ago was, I think at certain points, 20% or higher that they would start cutting in July. Now it's no chance. And if we go out to September, this is the one now to watch. It's back close to 50-50. But we've seen this at certain points as recent as a week ago. Majority thinking that there is definitely going to be a cut, maybe two cuts by this September meeting. And so really interesting to see. Yeah, that bond move yesterday was crazy. You saw a rally in treasuries for like that 10 to 20 minutes or so, and then they sold all the treasuries off really, really hard. Anything else on your board? Obviously, the Eurodollar move was the biggest mover as I go across here. Nice to see dollar Swiss franc actually rallying continually into this morning, back above 80 cents. It's been a rough ride for this market the last couple of weeks, but anyone that's been hanging in on the carry trade, long dollar, or looking for a reversal in this extreme, you finally got it. Down below 79 cents was the low, back above 80 here today. Anything else that you're looking at?
No, dollar yen's has kind of reemerged as
just strong.
It's strong, but there's some headlines coming out in the next week, really the next 4 or 5 days, that is going to be pretty pivotal. So overnight, the Japanese 10-year hit all-time highs that we haven't seen since 2008.
Okay.
We've got a Japanese election on Sunday. We have Japanese inflation this week.
Nice.
So you're talking about a slew of events that can get very interesting in this market. The bond market is reemerging. The bond vigilantes, that term is back again. The news they'd love to talk about it, but fiscal responsibility or lack thereof,
sure,
is coming back into play. So these markets are going to get real interesting. This one does have a 4-day roll today. So that's
what I was going to say. They were looking particularly juiced today.
Yeah.
6 points for long dollar yen.
Yeah.
Into the close.
Yeah. There's a Japanese bank holiday on Monday.
Gotcha.
So that's why you have a 4-day roll. So.
Well, that market obviously not thinking right now that any of the events that you just quoted are necessarily hawkish for the Bank of Japan, just because we're set up right at 150. I mean, this is a market that in recent weeks has been as low as 142 here in July. It got just below 143, so the 142 handle didn't get down to 142 even necessarily. But if you go back in time enough, I mean, we traded down to 140, and that was the kind of peak of carry trade is unraveling, Bank of Japan is hiking, the U.S. is cutting. And now with all of that stuff that you're talking about, which sounds like it could be painted relatively hawkish for the Bank of Japan and for Japanese interest rates, and potentially bullish for the yen, market not thinking so, hanging in right around its highs. So that'll be really interesting to see. And yeah, those 6 points obviously not risk-free given all of the information that'll be coming out of Japan for the next couple of days. But a really interesting market that is giving you some of the highest volatility if you're into that. I don't really have anything else. You said we have a PPI here in a few minutes, 45 minutes. PPI is expected, just like the headline inflation numbers yesterday, to be slightly higher. And then from there, a couple more Fed speakers, and then, some Japanese data throughout the night. Anything you want to hit on before we get into our study?
No, not really. I mean, UK inflation data came in hotter than expected, but that was kind of a non-event. Cable didn't move too much.
Well, and again, kind of to my point of, it seems like these economic events and all these news stories, they're meaningful, but when you have like a higher degree of like, it seems like people are just piling back into this U.S. dollar trade, which they have on or off for the last couple of years. Ever since we saw the huge dollar rally in 21, 22, there's been, I mean, probably more than 5 times that it's like, oh, the dollar's unraveling. Oh, actually, now we're all piling back into the dollar trade. And yeah, you get a higher than expected print out of UK inflation, and this pound can barely muster up a 20-point rally, can't even get back to 134. And this is a market that was trading, that looked like it was going to trade 140 2-3 weeks ago. So we'll continue to monitor it. The story right now just seems to be dollar bullishness. A lot of it seems like it's coming off of interest rates in the U.S., so we'll watch all of that. But let's actually pull up the slides and take a look at really fun study. Trading FX volatility shocks. Should you fade them? Should you follow them? We're going to take a look at a lot of data points here, Paul. Basically, the setup for this study is intraday trading, okay? We're going to be looking at hourly candles. And I guess the best way to say it is, if you got a big move in 1 hour, should I go with that move or should I go against that move? What is the next hour report? What is the next 2 hours report? What is the next 4 and 8 hours report as the average result of that market's price action following a big hourly candle? Right off the bat, I mean, what I love to ask people this as almost like a Rorschach test kind of thing. If you saw a big hourly candle, and let's bring up a chart here. Glenn has highlighted this big move that happened July 10th at night at 8 o'clock Eastern. So obviously not a big economic event, but just a big move. And you'll get a couple of these every week, it seems, in some of these major Forex pairs. Does that make you want to buy or sell that big drawdown, that big red candle? Oh,
the big red candle. So typically I would personally look to fade it. That doesn't always work, I can tell you that. You really got to watch the price action when these markets get moving in one direction. Because if they get to a key level and they keep going, it's like, okay, maybe I shouldn't be buying here. And then you're
everybody bought at that key level, and now everybody's getting out below it
really quickly. Yeah, it really depends on the situation, and the mechanics of your trade got to be tight if you're playing the kind of the fade, some of these big moves. So,
that's a great point here, because whether you are fading or following any of these moves that we're about to analyze across 7 pairings of U.S. dollar and other major currencies, the mechanics have to be big, and the data will actually show that as we go through it. It can't be just like, oh, that's a big hourly candle. Yeah, like I'm going to go with the trend or go against the trend, and then I'm just going to see what happens. Because even if the odds are in your favor, let's say that the odds are in your favor for fading that move. So if you see a big drawdown in 1 hour, buying it. If you see a big rally in 1 hour, selling it. And I've seen so many people, myself included, make 5 ticks, 10 ticks, and then just be like, oh, this is great. This is, easy. I've won 2 out of the last 3. And so I'm up, 10 ticks on my winners, and I just took a 10 tick loser. And then it just takes one, oh, I bought it. There was a big hourly drawdown in Eurodollar to 116, and I bought it. And then it got below 116, and it just collapsed to 115. And I lost 100 points on that trade to take all of that, those prior gains and everything else away from you. So consistency, always the key. I'm glad that you brought that up off the top. But here is the setup for the study, Paul, looking at Euro, Pound, Yen, Aussie, CAD, Swiss franc, and New Zealand dollar against USD for the last year, analyzed all the hourly moves for the last year, and essentially filtered for, okay, if there was a 0.2% or a 0.3%, 0.4%, et cetera, down move, up move, what was the action afterwards in the next hour, in the next 2 hours, 3 hours, 4 hours, 8 hours, and just essentially looked at a win rate based on if it was, 0.4% in hour 1, 0.4% down move, and I bought it, in the next hour, would I have been profitable? In the next 2 hours, would I have been profitable? Or if I had sold that down move following the trend, would I have been profitable in that next 1 hour, 2 hour? And so obviously nothing is lost. The faders either win or the followers either win in any of these scenarios. Surprised to see, before we get into the actual data, that you are seeing more fades than follows right off the bat. Paul.
Yeah. I wouldn't necessarily say I'm surprised, because you do kind of see there's some mean reverting characteristics in FX markets this is kind of what you get. But dollar yen being follow across the board isn't exactly surprising, given it's been a trending market better part of 4 or 5 years. So it's really hasn't, like, that's a market where it has a different dynamic going on, where something like a euro dollar or an Aussie dollar, that's an easy market where you, not necessarily easy market, but a market where you see the kind of big moves and then the fade will fade the next couple hours.
More consistent reversion.
Yes, exactly. That's exactly how I should put it.
And yeah, the thing that's always interesting to me, whether you're looking at studies like this, which is pretty pure price action, buying or selling, or even a lot of the option studies that we used to do, based on like, okay, like, and it's essentially the same concept, right? Where it's like, if volatility is low to medium, do you tend to get inside moves? Do you tend to be profitable from selling options or buying options? And there was always like a threshold where if volatility was really high, selling options, actually the win rate on it started to lessen, whereas you might think like, oh, well, it was a really high volatility, really big option premiums, and so I'm getting the biggest prices, so it should be the most profitable. But sometimes you'll see volatility cluster, and so I'm not surprised to see it, but it is always interesting to see that, like, you see around the big moves 0.5% or 0.7% in 1 hour. That's a big move in an FX market. You're seeing more follows, which is to say the next hour there's actually more volatility in that same direction. Yeah. Whereas the small to medium moves, you're seeing most of the reversion focused around there. It's kind of like the equivalent for those options traders of like selling options in the S&P when IV rank is like 10, 20, 30, 40%, sometimes can be more profitable even though you're getting smaller prices than if IV rank is 100%. Because if IV rank is 100%, vol is the highest it's been in the last year, the market is really, really moving. And so that's an interesting trend that I picked up here, is that some of the best reversion results are in that kind of small to medium moves on an hourly basis, whereas when you start to get big moves on an hourly basis, that's when you start to see that trend following, the continuation of those moves. Now, here are the win rates for each of the markets based on if you had faded these moves, what would happen in the next hour, 2 hours, 3 hours. So now essentially any move outside of a 0.2% on an hour, which is what we're kind of categorizing as a big move in this study, what was the success rate in the next hour to 8 hours? And the big thing to me, Paul, as I was looking at this with Glenn yesterday, is there's a lot of green on the board. So fading the move has the last year been more successful. Again, historical results not indicative of what's going to happen in the future. But another interesting trend here is that after 3 to 4 hours, these odds don't seem to get better, which is to say you should probably look for that. If you're day trading or looking to fade a move, you should probably look for that reversion in the first couple hours of trading.
Yeah, that's normally when you're going to see it or you're not going to see it at all. I like the way that Glenn has kind of laid this out, and that as you kind of hold this position for longer when you're fitting a move, your odds of actually making a profit kind of start to go down, because different things start happening in the market, different news events, the narrative starts to change, whatever it may be on that day, and it kind of takes out that, just whatever that narrative is. Yeah.
The way that I kind of view it is like, if you're day trading or you're trying to get an edge in the market, you're really looking for market inefficiencies. And so if something crazy happens, if there's a non-farm at 8:30 Eastern time and you're like, oh, I think this is too big of a reaction, or I don't think this is big enough of a reaction, that potential for inefficiency is probably unfortunately, it's probably in the first couple of seconds, but to minutes to maybe an hour or two. Whereas to your point, after like 3 or 4 hours, they've priced that event.
Yeah.
And so now you're kind of betting on something else happening, which is like, okay, you can try to predict what the news story is going to be today at 1 o'clock in the afternoon. I have no clue. But just to wrap up, obviously the opposite side here is a lot less green going with the trend, but it is interesting to see that these green numbers start to populate going with the trend over a longer time frame. And so that could more mean like, and you see this a lot, that maybe it's a strong non-farm number and the dollar's rallying, and then maybe it comes back a little bit in the next hour or two. But then as the next Asian and the next European session come in, they digest that as another, dollar rally. That's at least how my brain sometimes thinks about those things, but not a lot of consistency for following the trend. So we'll stick with more of the fading strategies, at least for setups like this. Contrarian strategies have the edge when reacting to major hourly moves for intraday scalping in most pairs. Dollar yen, the last year and probably last couple of years, given how it's been trending, has consistently been favoring momentum trades. Dollar CAD posts the highest win rates. Yeah, we saw some of those win rates at 58, 59%, which is crazy, of fading those bigger moves on an hourly basis in Canadian dollar. Aggregated data shows timing trade exit is less important. Profits can be seen in as quickly as an hour. So yeah, hanging around too long, probably not for the best. But that's it, Paul. Thanks for joining on that study.
Thanks, Frank.
We'll throw it now to Tom, Tony, and Vanetta coming up next. Stick around, everybody. Peace.